right, so what's the difference between a calendar spread and a diagonal spread, and which one kind of wins out when it comes to trading? So I want to share with you this insight because a lot of people get confused on, hey, should I do a calendar spread? Should I do a diagonal spread? I want to show you a little bit of a comparison of calendar spreads versus diagonal spreads and maybe which one to use when. Okay, so if we want to take a quick peek at this little diagram here that we generated, a calendar spread basically is the same strike at different dates. And what you're really looking for is a capture of a theta decay. So when we look at something like this, is we've got the same exact strike. So let's say it's a 360 and a 360, except the one that we have right here might be 20 days until expiration. So we've got the DTE, and then that's the one we're selling. So we're going to be selling this one. And then the one that we're buying might be 27 days. Okay, so that's our purchase price. And the one that decays is going to decay a lot faster, right? The shorter duration will decay a bit quicker. So what you're doing is you're making from usually non-directional movement. Now you can position calendars a little bit more bullish or bearish if you prefer, and that gives you somewhat of a direction. Now, a diagonal spread all of a sudden already does that almost immediately. So it gives you a little bit of a directional push right away. So what you're doing is you're offsetting a strike. Let's say instead of a 360 and a 360, you're going to go with a 360 and maybe a 355. And it's going to offset a directional because you have different strikes and different dates. And really, a diagonal is a combination of a calendar and a vertical. And that gets you kind of a diagonal. You get a little bit more room either to the upside or the downside. So I'm going to show you this construction here on the panel and platform. That way you get a little bit of an insight and see how it really plays out. And we'll just pull up, how about CrowdStrike? Okay, so if we do a diagonal, I'm going to go 18 and 26 days just for simple conversation's sake. And let's say we go to the 490. Okay, we buy a calendar over here. And this calendar has a 7-day difference. I'm going to just bump up some of the contracts to maybe 2 contracts, and that's fine. So you can see this has a little bit of a non-directional feel right now. We're going to bring it back to maybe, how about 480? So this is kind of a typical calendar where we have the same exact strike, but different expirations. Okay, and we're paying about $358 a piece, so times 2. So that's kind of our cost for these calendars. Now with calendars or diagonals, you don't usually want to let them expire. But what we've got is we've got almost a non-directional feel here, which means our delta is almost non-existent, right? We've got no delta. We're trying to make most of our money from a theta, but really it's actually the vega. So we've got these two that are kind of working in our favor. Now you can make these a little more directional because sometimes, you know, prices are moving, wiggling around. So if I go in and just say, okay, well, let's bump it up to about a 530, that gives me a directional calendar, which is a little bit different. It's what it's doing here is, rather than being a diagonal, which is a little more aggressive kind of at the money, this is being directional, but not as aggressive in a way because your capital at risk here is, it's only about $107 a pop. So you're paying about $214 at most here on the risk. And if it goes up just slowly, then you get out of the position and that's fine. If it goes up slowly and pulls back, you're a little bit more cushioned. Whereas a diagonal is more aggressive. You want it to kind of keep going and going and going in that zone and area. So by doing something like this is, when you're going in like doing a 510 or a 520, it allows you to drive that cost down on these little bit of calendar spreads, but still get directional. Now, when we go into a diagonal, just to bring it back to about a 480 right here, we've got this. If we go in and go to, let's go to July 3rd over here, I could go in and sell, let's say, a vertical spread over here. And now that gives me a little bit of a variation. You can see it diagonalizes a little bit of my calendar, giving me a little more upside room. And I could do this also on the other side, making it a little bearish. So that's one way of approaching it. I could also buy an at the money vertical or just even slightly out of the money. And that also diagonalizes it. So what it's doing here is by adding this 490, 495, it's kind of shifting one of these in order to make it slightly, bullish, because we're adding a little bit more power to it. Okay. Now we can do this in this one as well. You can go to custom, and then what you can do is kind of modify and manipulate some of these. So I can move this kind of to the downside and make it bearish, or I could move it kind of to the upside here and make it bullish. Actually, let's just do it a little bit right there. And now what I've got is a diagonal basis right here. So this is another way to do it by offsetting these strikes. And now I've got a 485 that I'm selling versus the 480 that I'm buying. So you're buying a stronger delta position than the one you're selling, right? You're buying stock at 480, selling it at 485, converting it and making it a little bit more bullish. So that's another way to do it. Now, the thing here, though, is by doing something like this is rather than doing a directional calendar that's out of the money, you're getting more aggressive. And look at the capital at use here. Now, the capital at use here is a lot more. It's like $1,100, whereas the other one was only like $200. So there's a difference there in the way that they're structured. So if you want, you could do something like this, and then the reaction is a little bit better. But obviously, what you could also do is instead of doing something like that, you could go and say, okay, well, rather than doing this, I'm going to go back and do a calendar, but I'm going to go to let's say a 530 and go out of the money and just make it super cheap. I'm not sure exactly if the price is exactly perfect or anything like that, just simply because, well, you know, it's after hours. So maybe right here, this is a $1.47. So it's out of the money. It's fine, you know, but the point is that the out of the money zone or area is going to be a lot cheaper. Maybe it's not quite, you know, $200-300. But even here, it's $500. So you're saving half the cost. And if it does go up, you win. The downside of this is if it overshoots, you might actually lose if it overshoots too quickly. Whereas doing a diagonal, more or less, you've got a lot more room there to the upside. So it's better in that regard. So as far as, you know, figuring out which one is better, which one is works out, well, calendar is really nice if you don't want to get too aggressive, right? If you still want to go bullish, but you don't want to get too aggressive, a calendar is a subtle, hey, we're near the highs. I still want to go bullish, but I don't want to be that aggressively bullish. Calendar would be the one to go with. You know, if you're kind of at the low end or the stock market sold off or there was a couple of big down days or a big down week, a diagonal might be the better approach because now you've got more room to the upside. And of course, vice versa on the downside, right? So same principles apply, just inverted. So those are kind of the things that you're looking at is that, okay, calendar is just less aggressive in any form of direction. But you could go a little bit bullish on the calendars or even bearish. But that's just assuming you're not looking for a big major move to that direction. Whereas a diagonal, what you're doing is you're looking for a much bigger directional move and you're getting a little more aggressive. So that's the question, is what's more important? Now, we'll say another thing to consider is that sometimes rather than getting more directionally aggressive with a diagonal or the strategy, you could just put on 2 or 3 calendars that are either bullish or bearish more directionally, and that actually might be more peaceful for you. Now, it's something you have to determine and consider and see if it makes sense for you, but it's just something to look at and see what makes sense based on your strategy, your mindset, the way you do things and operate things. But that's kind of another thing to look into. Anyways, I hope this helps. Truly appreciate it. We just did a class actually on calendars here and diagonal spreads. So if you're interested in those things, check out our website, optionsblackbelt.com. Hope you get a lot out of it and you can learn more about some of these classes. These were like 3-day workshops that we did on a lot of cool stuff on these types of things. So anyways, hope you join me. Appreciate it. Enjoy the free videos on YouTube and I will see you on the next one.